You've done it. You put in the work, managed your payments, and achieved a 675 credit score. It's a significant milestone, and you're likely thinking you're set to get approved for a new home or car. But what if that good credit score is actually costing you tens of thousands of dollars in interest on a major loan? This isn't speculation, it's a financial reality. In this video, we'll examine what a 675 credit score truly means to banks and lenders. I will also provide the exact steps you need to take to elevate your score from good to excellent and secure the best possible rates. First, let's be clear. According to major scoring models like FICO, a score from 670 to 739 is officially considered good. You are out of the fair and poor categories, which is a commendable achievement that signals to lenders you are a responsible borrower. However, good is an incredibly broad category. Consider this. You might be a good enough runner to complete a 10K race, but that doesn't put you in the same class as an Olympic athlete. A 675 credit score is at the very beginning of the good range. Meanwhile, the average FICO score in the US is now around 717. So while you are in the correct category, you haven't yet reached the level that compels lenders to offer their most competitive terms. That difference directly impacts your finances. Nowhere is the difference between a good and an excellent score more apparent than with a mortgage. With a 675 score, you can certainly be approved for a conventional loan, as most require a minimum score of only 620. You will receive offers, but they will not be the best ones available. Let's illustrate with a hypothetical $300,000 30-year fixed-rate mortgage. Based on recent data, a borrower with an excellent score of 760 or higher might be offered an interest rate of around 6.75%. With a 675 score, your rate is more likely to be around 7.25%. That 0.5% difference may not seem significant, but let's examine the numbers. At 6.75%, your monthly principal and interest payment is approximately $1,145. At 7.25%, that payment increases to about $2,049. That's an additional $104 every month. Over the 30-year term of the loan, you will pay over $37,000 more in interest simply because your score was good rather than excellent. That is a substantial amount of money that could be used for a new car, a significant home renovation, or a major contribution to your retirement savings. Furthermore, lenders may also require a larger down payment or impose stricter debt-to-income limits for a borrower with a lower score. The situation is quite similar when financing a vehicle. A 675 credit score will allow you to obtain an auto loan, but you are on the cusp of what many lenders consider prime. For a new car, the average loan goes to a borrower with a score closer to 740. How does this affect your wallet? Imagine you are financing a $25,000 used car for 60 months. A prime borrower might secure an interest rate around 9.06%, but with a 675 score, you fall into a tier where rates can be significantly higher. Even a small increase in the interest rate can add thousands to the total cost of your car over the life of the loan. Lenders perceive a lower score as higher risk, and they price the loan accordingly. The positive news is that improving your score from 675 into the very good or excellent range, 740 and above, is entirely achievable. Here are the 4 most effective actions you can take immediately. First, review your credit reports meticulously. You can obtain your full credit reports from all 3 major bureaus for free. Review them carefully, line by line, and dispute any errors you discover. An inaccuracy could be suppressing your score. Second, manage your credit utilization. This ratio, which is the percentage of your available credit you are using, accounts for 30% of your FICO score. If you have a $5,000 balance on a card with a $10,000 limit, your utilization is 50%. The goal is to keep this figure below 30% on all of your cards, but the real objective for a significant score increase is to get it under 10%. Third, automate your payments. Your payment history is the single most important factor in your score, representing 35% of the calculation. A single late payment can have a significant negative impact. The solution is straightforward. Arrange for automatic payments for at least the minimum amount due on all your accounts. You can always pay more manually, but this ensures you are never late. Fourth, Allow time to work for you. The length of your credit history constitutes 15% of your 𝐔𝐒𝐄𝐅𝐔𝐋 score. For this reason, avoid closing old, unused credit cards, particularly those without an annual fee. Keeping these accounts open maintains a higher average age of your accounts and helps keep your overall credit utilization low. So, is a 675 credit score a good score? Yes, it is a solid foundation. It demonstrates that you are a reliable borrower. However, it should be seen as a starting point, not the final destination. A 675 score gets you approved, but it costs you money. The ultimate objective is to reach the very good or excellent classification, which is a score of 740 or higher. In this range, you qualify for the best interest rates and most advantageous loan terms. You now have the precise, actionable steps to get there. By focusing on these strategies over the next several months, you can dramatically improve your financial standing. What is your credit score goal? Please share it in the comments below. Thank you for watching.